So imagine for a second that you had a credit card that charged you zero interest for years. You could borrow $1 million, pay zero interest, and go buy houses, stocks, whatever you wanted. You'd feel pretty rich, right? Well, for the last 20 years, that is exactly what the biggest investors on Wall Street have been doing. But instead of using a credit card, they used Japan. This is called the Japanese carry trade. Big hedge funds borrowed money in Japan for free because interest rates in Japan were zero. They turned that money into US dollars and they used it, among other things, to outbid you on houses and apartment buildings here in the United States. But last month, the bank called. Japan, as it turns out, is raising its interest rates. The free ride is over. And now those big institutions are panicking and our global economic future is looking a little uncertain, if you will. Well, I am Leah Courage and my husband John and I are real estate brokers and we run the Courage Group serving the North Puget Sound. And today we're talking about a topic that will directly impact the real estate market and it's called the Japanese reverse carry trade. We're covering what it actually means in plain English, why people are suddenly very nervous about it, and most importantly, what the possible real estate pitfalls and opportunities could be for everyday investors, home buyers, and sellers if we see volatility on the road ahead. So this video also is educational and speculative only. We are not financial advisors, and this is not financial advice that we're providing in this video, but our goal is simple. We want you to understand the forces that are moving behind the scenes and that are impacting your investments and future so that you can make clearer, calmer, and more strategic decisions with your money. Imagine with me that you have two banks. One bank will lend you money for almost nothing at, say, 1% interest. The other bank will pay you 5% interest to store your money with them. If you're allowed to borrow from Bank A cheaply and then move that money into Bank B to earn more interest, you can pocket the difference. That is the core concept of a carry trade. You borrow cheap here and you invest it here where returns are higher and you live on the spread in between. So for decades, Japan has been the cheapest place to borrow money because they've had near zero interest rates for a very long time. So global investors and hedge funds and massive institutions have been borrowing money in Japanese yen, converting it into US dollars, and investing it into higher yielding assets like US bonds or the stock market or real estate and even cryptocurrency. As long as interest rates stayed low in Japan and the yen stayed weak, then this strategy worked beautifully. It's like running your business where inventory costs almost nothing, but you sell it at full price somewhere else. So sounds too good to be true, right? Well, let's keep going. So you may be asking yourself, why has this strategy worked for so long? Well, Japan's economy has been stuck in very low growth. Their central bank kept interest rates near zero to stimulate their economy starting in the late 1990s. And that made the Japanese yen the cheapest currency in the world to borrow. Meanwhile, countries like the United States raised interest rates aggressively to fight inflation. So that created a huge gap between cheap borrowing in Japan and higher returns elsewhere. So trillions of dollars quietly flowed out of Japan and into global markets. Most people never notice this because it all happens in the background between massive institutions. But this flow of money helped create the wild stock market growth that we saw over the past few decades and liquidity in crypto markets and even some of the most intense demand that we saw in real estate in the United States during the ultra low rate years that we just climbed out of. So why is this suddenly being talked about right now? What's changed is that Japan finally started signaling that they might move away from zero interest rates, and they've actually already taken steps in that direction. When Japanese rates rise, borrowing in yen suddenly becomes a lot more expensive. The entire math of the carry trade starts to change. If borrowing costs rise while asset prices are unstable or falling, then investors rush to exit those positions, which means sell before their losses stack up. And when you get massive institutions all moving at the same time, the impact can be sudden and completely dramatic. It's a lot like when everyone in a crowded movie theater suddenly smells smoke at the same time. No one just calmly gets up and walks out one by one. Everybody jumps up at once and panic spreads and the exits get jammed and the movement to the exits itself becomes the chaos. Now let's talk about the word reverse, as in the reverse carry trade, because this is where it all comes together. The reverse carry trade happens when those same investors who borrowed cheap money in Japan suddenly need to unwind, aka sell their positions. So that means that they have to sell the assets that they bought, convert that money back into Japanese yen, and repay their loans. Imagine if millions of people all tried to sell all of their investments at exactly the same time, also while scrambling to pay back a loan. That creates financial total calamity. So when these huge players start unwinding their positions, they don't just sell one thing. They sell everything that they can to raise liquidity. Think of it like a massive tide suddenly rushing out to sea. The water doesn't just leave one beach. It drains every single connected inlet and harbor and bay all at the same time. And the boats that were floating just a moment ago are suddenly stuck in the mud, not because they were bad boats, but because the water itself has disappeared. If this kind of behind the scenes financial breakdown is helpful for you, then please make sure to like this video, subscribe to our channel, and turn on notifications so that you never miss content that helps you navigate real estate and the broader economic landscape with clarity and confidence. And if you're planning on buying or selling real estate anywhere in the North Puget Sound, or you want help understanding how these trends might affect your personal situation, our contact information, as always, is in the description below, so please reach out and we would be honored to assist you. So how could all of this impact U.S. interest rates? Well, here's where this connects directly into our everyday life. When global markets get unstable, everyday people and institutions put their money into what are seen as safer assets, especially U.S. Treasury bonds. When demand for bonds rises, bond yields often fall. And when bond yields fall, mortgage rates often follow. So in certain scenarios, even when things feel scary in financial markets, we could actually see mortgage rates start to come down. That's one of the paradoxes of economic stress. Fear often creates opportunity if you know where to look and how to act. So, all right, how could all of this impact the US housing market? Well, if we do see financial chaos that's tied to the Japanese reverse carry trade unwinding, several things could happen. Emphasis on the could, because again, I'm not a financial advisor and I'm not an economist and I'm not going to make any promises here. We could, however, see buyer demand temporarily pull back due to uncertainty. We could see home prices go down in the short term in certain overheated real estate markets, but we could also see more favorable lending conditions if bond yields fall. And for long-term home buyers, we might see a rare window of opportunity where home prices come down at the same time that mortgage interest rates come down, meaning that as a buyer, your money goes much farther. Historically, when the headlines are scary, real estate opportunities actually open up. Now, on the flip side, you might be asking, what could this potentially mean as a seller? Well, here's where it gets interesting, because this kind of real estate environment puts even more importance on pricing your home correctly, as in not overpricing when you put it to market. And not only that, but home presentation matters now more than ever in these types of circumstances. So when buyer confidence starts to wobble, which it undoubtedly will if there's global financial turmoil, then homes that are overpriced or not presented well are going to be the first to stall when they hit the market. Well-priced homes, on the other hand, that present beautifully often become sought after. Real estate is still, of course, one of the most trusted long-term stores of value in times of uncertainty, especially in markets like Western Washington, which people move to and buy in because of the great lifestyle that we have here. Now, there are a lot of opportunities hidden inside market volatility. So every major financial shift in history has created both fear and fortune. So the goal here isn't to predict the exact outcome. That is virtually impossible. The goal is to stay liquid, stay educated, avoid being over-leveraged, and be ready to move when opportunity presents itself. If markets become unstable, then cash becomes very powerful and strong credit becomes powerful. patience becomes powerful, and well-located real estate often becomes extremely attractive during periods of financial chaos. What's fascinating is that most people will never hear the phrase reverse carry trade on the evening news. They'll just see scary headlines about global financial markets without ever being explained to as to exactly what's happening behind the scenes. This is why even understanding the most basic global finance concepts can actually give you an incredible advantage. You don't have to be a trader, you just need enough awareness to avoid making ultra emotional decisions when things get dicey. We believe and have seen firsthand in our business that fear-based reactions can totally destroy wealth or the opportunity for wealth, while being patient and informed actually builds wealth. So whether the reverse carry trade unfolds gently or violently, people who win in these cycles are not the ones that are glued to the scary headlines and the daily panic. They are the ones who sit quietly, observe calmly, and maintain a strong financial position and move when opportunity shows up. To quote the British, keep calm and carry on. So if history teaches us anything, it's that well-located real estate remains one of the most resilient asset classes over time. Even in volatile financial cycles, people still need homes. They still need to relocate. They still retire. They grow families. The human need for shelter never goes out of style. So to summarize, the Japanese reverse carry trade sounds complex and intimidating, but at its core, it's simply the unwinding of cheap global borrowing that has quietly fueled financial markets for years. If that unwind accelerates, yes, we could absolutely see volatility in global financial markets. But inside that volatility lives opportunity for buyers, sellers, and investors who understand how to stay calm and strategic rather than be reactive. Thank you so much for watching. And if you enjoyed this information, please be sure to like this video, subscribe to our channel, and turn on notifications so that you never miss a new video about real estate, markets, and life in the North Puget Sound. And also, if you're planning on buying or selling real estate in the North Puget Sound, we would love to connect with you. Our contact information is below as always, and we would be honored to help you make your next move with confidence. So thank you again so much for watching. Keep exploring, and we will see you in the next video.